NEO is an interesting one. The Treasury, well, the Senate in the States, I think yesterday have passed a piece of legislation which will delist companies like NEO from the New York Stock Exchange. Hey guys, welcome back to the channel. So over the last 2 to 3 videos, we've been speaking about dividends and dividend stocks. On Tuesday, I asked you if you would like me to do a tutorial, a step-by-step guide of setting up a pie in Trading 212. Essentially selecting companies to go into a portfolio where your money gets invested into. That's what we're going to do today. I'm going to take you through Trading 212, show you the steps, get you started. But before we begin, I've got 2 important pieces of housekeeping, the first of which I'm very excited about. So I was approached 5 to 6 weeks ago to do collaborations with a couple of brands. Those videos are going to arrive this month. And for me, it's very exciting because I've always wanted to do some kind of collaboration with a brand, but I've always wanted to do it with the right kind of brand as well. So one that will answer questions that I have here on this channel and also deliver value to you guys as well. So it's not just a plug or a hard sell. It's actually just showing what they do and how they can help you. So I've got a couple of those coming this month, and I'm really excited because it helps me to make this a little bit more sustainable. This is hard work, and it means that I can keep the lights on. The second piece of housekeeping is Stake. If you've not watched the first video where I reviewed them to understand what they're all about, go and watch it right there. They are giving away 2 free stocks throughout December in opposed to 1. It's 2 free stocks of Nike, GoPro, or Dropbox. Caveat is you have to fund your account with at least £50 within the first 24 hours. Please remember to do that. I forgot to do it, so I didn't get my free share when I opened my account with them. But if you want to bag yourself 2 free shares this Christmas, then definitely go and use my link in the bio and in the comment section below to grab yourself 2 free shares. With that being said, let's jump into Trading 212 and start building some pies. All right, so we are going to be using Trading 212, and I'm going to be looking at some stocks, and we're going to build an equity portfolio. Now, I'm going to use that phrase and that term because it's a lot sexier than saying building a pie. Equity portfolio definitely has a better ring to it. An equity portfolio essentially means that we are building a portfolio or a collection of companies. It's really what it means. As sexy as it sounds, it's actually very simple. We're building a collection of companies where your money will end up being invested when you use Trading 212. Now, when you're building a portfolio, you can have bond portfolios, you can have equity portfolios, you can have property portfolios. For this video, we are going to focus on equity portfolios because we are selecting stocks, companies, equities in Trading 212. Now, it goes without saying, guys, and this is where it gets a little bit serious, and I have to give you a disclaimer. Please do not go and take what I say in this video as verbatim as the portfolio that you should have as a new investor. That would be a mistake. I don't know your personal circumstances. I actually have purposely not scripted this video or done any prior research because these will not necessarily be the companies that I would even put into a portfolio for myself if I built it. So please don't just go and copy this and think, oh, Pete knows what he's talking about, I'm going to copy what he does. Please do your own research. When you invest, it is all about research. It is all about conviction. You have to believe in the companies that you're buying. So please don't copy what I'm saying. Please don't take this as financial advice. Use this as a basis to do some further research of your own. Now, that's out of the way. And I know that became really serious right there, but it's necessary. Let's get into Trading 212 and start building an equity portfolio. Okay, so I've just fired up the app here, and obviously we're on Trading 212. You're going to land on your watch lists and stuff. I think that they could really do this where you just land on your portfolio, but they've set it up the way they've set it up. But you need to go onto your portfolio, and this is mine. I don't have a lot of money here with Trading 212. Most of my money is invested in funds, and I've got quite a bit with Hargreaves Lansdown where I hold my Tesla stock, which is my largest holding, really. I hold a little bit here because obviously I review Trading 212. I talk about them, so I might as well use them as well. Now, you have to go to the pie tab right next to your investments to get access to the pie section. And all you need to do is click create. Now, when you land on this screen, like I said, you've got stocks, ETFs, and you can also look at any companies that are on your watch list currently. For the purpose of this video, we're going to be focusing on the stock section only. I'm not going to touch on the ETFs. Now, on the stock section, you've got the most popular ones, which are being bought and trending right now within the app and across the markets. You've got dividend stocks, which we've been speaking about over the last 2 to 3 videos. You've got growth stocks, high volatility stocks, low volatility stocks, speculative stocks, and you can also browse through all 2,340 stocks that they have available on the app. Now, I think if you're a beginner, it's really important for you to understand what each of those stocks basically mean. So a dividend stock, like I've said in the videos before, and if you've not watched them, go and review them. That's one of them right there. Is basically a company that is trading on the stock market that pays dividends to its shareholders. So you partake in the profits of that business. When you look at growth companies may not necessarily pay dividends. They may pay dividends, but they are essentially going to be maybe new incumbent companies or companies that are growing right now. So growth companies. Those companies will likely be a little bit riskier in terms of their risk tolerance and your risk appetite. They'll be slightly riskier than dividend stocks, who might be companies that are well established, that have a strong balance sheet, that have really good profits and loss because they're making profits, and so on and so forth. So growth stocks will be a little bit risky. Then you've got high volatility. And what that essentially means is that this company's share price goes up and down. It might be a cyclical business where it might do really, really well at certain times of the year. Low volatility is essentially the opposite. The share price doesn't bumble up as much as possible. It doesn't really go up and down that much. But essentially, it's almost steady eddy. And again, they could also be the likes of dividend stocks as well, potentially. Then you've got speculative, and speculative will be really risky. These may be new incumbents into the markets that don't really have strong balance sheet, don't really have a track record just yet. It's important that you understand what each of those sections actually look like. And just for the purpose of this video, let's go through each of them and just maybe have a look at one company each, just in the interest of time, so we can get a flavor of the kind of companies that are in there. So dividends you already know about because we've spoken about dividends before. We've got AT&T. They're still trading at, well, they're trading up from the last video that I did where they were trading at $29 to $29.24. So they're up a little bit, not much. And their dividend yield is 7.17% still. Now, with this, you've got their market cap, which is $206 billion. You've got their profits PE ratio, which is 13. You've got their revenue, which is 181 billion. You've got their earnings per share, which is $2.23 per share. Now, when you're doing research for companies, the fundamentals are really important. The fundamentals are the financials and some other bits and pieces as well. But financials are very, very important. And particularly when you're talking about a company that pays dividends, these financials are actually crucial because their balance sheet will be strong. And you're going to find the balance sheet down here. And the balance sheet is essentially a measure of what assets they have versus the liability, what they own versus what they owe. And with them, they've got $551 billion in assets. Their liabilities are $367 billion. Essentially, their debt to asset ratio is 66%. Now, some people may say that actually this is quite high, but over the last 12 months, I believe that they paid off a huge amount of their debt. I think it was something like $11 billion I saw in some commentary. I can't verify that. You may have to go verify that, but they're paying down debt aggressively. But this is a strong balance sheet. You may say that they're highly leveraged in terms of their debt, but this is just for some fundamental information that you will need to research. I'll do a different video separately where we talk about how to read these properly. But that's AT&T in the dividend section. Let's come back out and just go into the growth section. What kind of companies do you have in here? So surprise, surprise, Amazon, Nikola, Alibaba, Salesforce, Netflix, Nvidia. These are companies that are growing. Amazon has done extremely well through COVID. So it's only right that they're actually classed as a growth stock. I'm interested to see if Tesla's actually in here or not. I can't see it at the top. It's not included in this. There may be a reason for that, but I'm surprised that it's not included as a growth stock in here. So that's the growth stock section. Let's just have a look at Amazon and just see what they're all about. Actually, they've taken a little bit of a tumble if you look at it from a 1 day perspective. If you zoom out to a month, see where they are. Yeah, the stock price is well, that's a month. Yeah, the stock price is still down. You've got the company details there. You've got CEO Jeff Bezos. You've got the market cap 1.6 trillion. Now, I'm interested to see what their balance sheet basically says because, they are a big company. Their assets, 225 billion. Their total liabilities, 163 billion. So they're 72.4% roughly in terms of their leverage. They're not paying dividends at this point in time, but that doesn't mean that they're not a good company, which comes back to what I was saying. Dividend stocks isn't the main focus, shouldn't be the main focus. Depending on what your plans are, you may need to employ a different approach. But that is Amazon in the growth section. Let's come back out and go high volatility and see what kind of companies we're having there. Now, Nicolal's in here, and it's also a growth company as well. And the reason for this will be because if you narrow out, look at the movement in the stock here. It's gone up and it's gone down quite a bit. So it's quite volatile. So it makes sense that Nicolau is a high volatility stock. Again, with this, if you're going to do fundamentals, it's going to be all about the research that you do. Let's have a look at their balance sheet. So assets, $239 million. And their total liabilities at the moment is $134,000. So actually, their debt to liabilities, debt to asset ratio is actually very, very good, 0.35%. So from a balance sheet point of view, they're doing very, very well from that point. I would say from my knowledge and experience of the EV market, I'll be asking questions about when they start ramping up production and actually start producing vehicles, whether that is going to go up. My guess will be that it will. And the question will be, will $239 million be enough to sustain them? And how long is it going to last for? So that's Nicolau within the high volatility. Let's have a look at low volatility. Low volatility, you've got the names that you would expect. Coca-Cola, right? Everybody drinks Coke. Everybody buys Coke. It's a consumer product. So low volatility. Their share price over the last year is down. That's probably due to demand and people tightening their belts. But Coca-Cola is a very well-established company. It's quite diversified as well. Let's have a look at their balance sheet. 86.3 billion in terms of assets, liabilities 74 billion. So their debt to asset ratio again is quite high, 78%. But it's Coca-Cola. So that's a low volatility company. And interestingly in there, you've got Pfizer, you've got McDonald's, you've got AT&T, you've got Tesco's, clearly. Notice how all of these companies are consumer-based companies. And a lot of these are dividend aristocrats. So if you've not watched the video, go watch that right there. So Johnson & Johnson, Walmart, Procter & Gamble, Berkshire Hathaway. Berkshire Hathaway isn't a dividend aristocrat. They don't pay dividends at all. But a lot of these in here are dividend aristocrats. So again, established companies giving you the foundation to your portfolio is extremely key. Speculative, this is the last one I'm going to check. NEO. Now, actually, I'm not surprised Tesla's in here, actually. I thought it would be in the high volatility mark as well, but it's not. NEO, speculative. Tesla, speculative. As you guys know, I'm quite bullish on Tesla. I own Tesla stock. Let's have a look at them. $593 up today, which is great news for me. You've got the company information there. Let's have a look at their balance sheet. They have got 34.3 billion in assets, liabilities, 27.6 billion. So their debt to asset ratio is 80%. Pretty high, but they're in an industry where it costs a lot of money to churn out their product and to market and to do all of the additional stuff. So that's just an overview of the different sections. The reason why I went through that is just to tell you and just show you what kind of companies are in there and try and get you to think about what fundamental information you need to be looking at for the companies. Balance sheets are important, but they're not the entire picture. Tesla for the longest time was not profit making at all. Only recently turned profit, but their share price is just going bonkers right now. Research is really, really key. So let's get on to actually building a pie. So let's do a little bit of a selection. Let's have a look at some dividend stocks. I'm going to put AT&T in there. And essentially all you do is you click on add to pie. Very, very simple. And at the bottom here, you've got one instrument selected. So when they say instrument, they're talking about a company. Don't let the language confuse you. Don't let it dumbfound you. An instrument in this context is the company that you've selected. So you've already got one in there, but again, you need to do your financial research, well, your basic research on the companies, looking at the financials and so on and so forth. Now let's pick another one. One of the ones that I did highlight in the video on Tuesday was Walmart. And I want to see if they're on here. They should be on here. They're not on there. Let's search Walmart. They are very, very popular in the States. Huge turnover. I think it's like $500 million in turnover. So Walmart, we want Walmart in this pie chart. So again, you're looking at the financials. You're going to do some basic research on the company here. Let's have a look at their balance sheet. 236 billion. Asset liability, well, liabilities of 161 billion, 68%. So let's add them onto it. So now we've got two. Let's go to Tesla, because I am bullish on Tesla, and I think that they will be a really good company to have in my portfolio, as I definitely have them in my portfolio. You add them to the pie. You've now got, oh, it didn't add on. You add them to the pie, you've now got three. Now let's come out of this one and let's start to have a look at, let's just get rid of that. Let's have a look at some low volatility companies. So let's get in some staples. Let's have a look at Pfizer. Now, Pfizer's been in the news recently because obviously the UK have approved them for COVID vaccines. The government is going to be rolling them out apparently from next week. Their share price, interestingly, hasn't really moved that much, and there's speculation as to why. A lot of this apparently has been priced in. So people who have bought Pfizer stock in the last 2 to 3 days thinking it's going to shoot up haven't necessarily seen that immediate move, because a lot of this was initially priced in. There are, however, a lot of short putters or short sellers against this stock that are going to start losing positions. And so there is an anticipation that this will move up in the next coming weeks or so. But at the moment, there hasn't been a sharp move as a result of the news. Well, not as sharp as many people has thought. Let's add these guys onto the pile. Let's just have a look at their financials first and foremost. Again, balance sheet 167 billion, liabilities 104, so 62%. But let's add them onto the pie. Now, really, really important, guys. I talk about diversification, which is key. Always try to bear in mind that you don't want to just go and buy all of your companies or put companies in this pie that are all in the same sector. So, for example, all pharmaceuticals or all tech or all energy or all consumer. You want to have a good mix across different sectors and industries. Very, very important. You need to diversify. Diversification is key. I'm going to select one more because I'm conscious of time. Let's have a look at a speculative stock. And you know what? Let's have a look at NEO. Now, NEO is an interesting one. The Treasury, well, the Senate in the States, I think yesterday, have passed a piece of legislation which will delist companies like NEO from the New York Stock Exchange. If you own NEO right now, that dip that you see in this graph is as a result of that legislation being passed. So if you hold NEO right now, you may be a little bit nervous. I'll talk about that separately in a different video, but something you should definitely know. But for the purpose of this, I'm interested to see their balance sheet. They won't really have a lot there because they are a new company. Well, actually, they have got a lot there, but you can see that their debt to asset ratio is a lot higher. They do have debt. I'm going to add these to the pie. So now you have 5 companies in your pie. Essentially, what you then do is you go on to next. And what you can now do is you can then decide in what proportion you want your money to be distributed across these 5 companies. So, for example, if you really wanted to be quite, I don't know, say cautious, for example, you could say that you want to have, say, 60% of your money go into Walmart. Then you could have, say, for example, I don't know, 20% into AT&T. Then you would need to reduce this down because that number cannot be more than 100. You may then want to have 6% in Tesla and maybe another. I need to get this down to 100. I might need to rejig this, actually, to be fair. Let's move that down to 50, actually, to give ourselves some room. And yeah, so where are we? So 6%, oh, it's going to have to be 5% in Tesla. Actually, no, let's do NEO at 10%. And let's also do Tesla. There we go. So your makeup here, sorry guys, it took me a while to get there, is you're going to have 10% in Neo, you're going to have 4% in Pfizer, you're going to have 15% in Tesla, 51% in Walmart, and 20% in AT&T. You can play around with these sliders to come to a determination, a proportionality that you are happy with. But the important thing is, again, you need to think about risk. So the reason why I've chosen Walmart being the biggest holding is because Walmart is a low volatility company. So you're not going to see the stock price move up and down so drastically. It's going to give you a little bit of security, and they pay dividends. Same thing with AT&T. Maybe not the security, well, the volatility side, but certainly you're going to get a dividend from them. So you know that that gives you a good, strong basis. I've chosen Tesla because I'm quite bullish on Tesla, and I put the rest into Neo and Pfizer. You have to come to your own determination of how you will build this out. But once you've done that, you click next, and then you go on to auto invest, which means that you can then set up your monthly direct debit and all that kind of stuff. It gives you a projection here. You click next, and you're pretty much done. Guys, I hope that you found that informative. It's a little bit different, and I didn't script this because I'm very, very conscious that I don't want people to just go and copy exactly what I go and build in a pie like this. You have to do your research. You have to have a reason behind putting a particular company in a position in your portfolio. You can't do this by just, finger in the air. You really do need to understand what you're doing and be convinced that you're making the right step. And look, guys, I know this. Sometimes you're not going to be 100% certain, which is why diversification is really important. You may be of the persuasion that you want to have a high risk portfolio. The question to ask yourself is, are you prepared to watch this go up and down pretty much every single day? And do you have the nerve for it? If you don't have the nerve for it, then you probably want to go for maybe a dividend stock. You maybe want to have a low volatility stock in there as well. Please bear this in mind. Security first. Don't go gung-ho if you're not prepared for the volatility that comes along with that. If you're a first-time investor, probably the best thing you could do is start off gently. Build some reputable companies to give you that foundation. As you become more confident, you start to keep your ear to the floor about companies, so on and so forth. Then you might decide, well, actually, I'm going to add them to my pie and allocate some money to them that I'm investing. You'll get to do this as you go along. This is a learning curve. It's not all going to click into place overnight. So please bear this in mind. If you want to join my membership group, I have a Discord group where we've got members in there and we talk about investing. We're going to be talking about stock picks and all sorts of stuff soon. Join us there. There is a join button down below right next to the subscription button there. So consider joining us, join the Discord group. You'll also get access to my investment course that will give you the basics to investing as well. But guys, thank you so much for your attention. I hope you found that useful. Please let me know in the comments if you want to see more of this stuff. I just want to be able to provide content that is going to be valuable to you. So the more vocal you are in terms of the stuff that you want to see, I will deliver those things. You've got to give what the masses are asking for. So I appreciate your time. If you've not listened to the podcast this week so far, definitely go check it out right there. We're fast approaching 2021 and Christmas. I'm very excited for the channel next year. And look, it's all down to you. And have a great weekend, and I'll speak to you next week.